Hey everyone, welcome back to another episode of Small Business Stories. I am Dr. LL, Loralyn Mears, founder of Steeris, bringing just every week amazing guests, right? It's just beginning to get a little bit embarrassing. I'm so grateful to all our listeners and all our guests who are really helping this show grow. So thank you for that. Today in the house, we've got David Ostrowsky. He is the founder of Cross Country Mortgage. And what he does is really focus on folks like us, our entrepreneurs, these self-employed professionals, right? All of us, how do we figure out home financing in the reality, in the context of business ownership? Because it's not like we've got these traditional W-2 income models knowing we get paid every other Friday, right? So, David, welcome to the show.
Thank you, Dr. LL. I appreciate it. I don't want to start off with an immediate revision, but I'm not the founder of Cross Country Mortgage, just to be clear. The founder has a lot more money than I do, that's for sure. But I am a loan originator with Cross Country Mortgage.
All right, so let's talk about that. So, first, know your facts, right? So I appreciate being corrected on that and getting that out there. And then secondly, let's take it from the angle of what it's like not being the founder, but really still having the access to what somebody else has done, and then using that to catapult, right? And to accelerate your business opportunities. How does that working out?
Yeah, I'll tell you what, it's great because Cross Country Mortgage is a phenomenal company. And I wouldn't say that just for the sake of saying that. And all of what's been done in the C-suite benefits a loan originator as myself. And anytime I'm in a better position, that means my clients are in a much better position. That gives me the ability to deliver the best results available for my clients.
Let's talk about the state of the union, right? The state of the market right now. We're in 2026, kind of, about midway through the year, and we've got a few trends that are happening. We're seeing homes sitting on the market 4 to 5 months longer than they did a year ago. We're seeing declines in pricing. Sellers are not getting their asking price, and we're still seeing somehow a shortage of inventory. Are all of these things, or how are all of these things starting to affect the market and what you're trying to do and bring to clients? Talk to us about what else is going on. What are you seeing through your lens?
Absolutely. So I've been harping on this for probably about a year right now, is the fact that the numbers, the math works for most people out there. I mean, the demand far exceeds the supply. So, for years, probably 2022 through 2024, buyers were sidelined by rates really spiking, rates going from beyond historically low, unprecedented levels, and more than tripling, in a pretty short period of time. And that squeezed demand, sent buyers to the sidelines immediately. Over the last couple of years, those very same individuals who were people that I spoke with in 2024, 2025, 2026, they want to buy. They have assets ready to deploy. They're comfortable with the monthly payment. They want to buy. Inventory has got in the way of that. But more so to the question here, I've said if anyone, whether you're a buyer or a seller, was somewhat interested in engaging in a transaction in the near term, if they stopped watching the news for 30 days, they would be more likely to engage in a transaction. That's my theory. Hasn't been tested, no data to support that. That is my theory. I think that the periphery is getting in the way of transactions more so now than ever. Recently, the very recent, almost 2 months now of geopolitics has had a direct impact to the financial markets in regard to oil prices and concern of inflation. So there has been that specific to the last 6 to 8 weeks, some volatility from caused by geopolitics. But before that, people, some would just come up with any excuse there is to, dip their toes in the water, numbers work, everything is great, but something gets in the way. And that's something that gets in the way or, can't even be defined as anything tied to the transaction, more so tied to emotions and the psychology of it.
Well, I like your theory. Again, I don't have any David either, David, but where you're going with it, just the idea of staying off the news for 30 days, and you talk about the emotional experience. I think we all have a healthier mindset because the news is just never good. It doesn't matter which area you're located in, and if you're watching the local news or you're watching global news, there's just a lot of bad stuff out there that's preventing us from living our lives and moving forward. And I do think the media is overhyping a lot of things and just everything seems to be overblown. I'll get off my soapbox. I think the media has shifted from journalism and reporting the facts and reporting the news to op-eds, right? It shouldn't be called news anymore. It should be called Channel X op-ed. But let me get off that soapbox. So,
I agree, but you're right. I want to lump onto your soapbox real quick
go
and
ahead.
feel free to steal my idea because I'll never do it. But I want to get T-shirts printed that just states you're a victim of propaganda. And then anyone who walks by me on the street will think, you know what? I probably am a victim of propaganda. Because that's your definition, I agree, your description I agree with, and it's less so reporting, more so proliferating propaganda.
Oh my goodness, yes. It's just that's exactly it. And I had a guest on here some time ago, Kira Shishkin is called Informed, and he sends out 5 headlines curated as a text per day. That's it. That's your news. It's everything that you need to know. No sensationalism, no emotional nonsense, no opinion, just boom. This happened globally and this is how it's going to affect your finances. It's
Yeah,
excellent. But
great
let's
idea.
get back to you here. So, it's great that you're focusing on really some underserved folks like us as entrepreneurs and small business owners. We work really freaking hard, right, to generate meaningful income. But a lot of us still struggle to qualify for loans, mortgage, and things like that because traditional models fail to understand entrepreneurs. They want those W 2s, they want the stability. How do you help folks like us overcome the limitations that the traditional lend to be stuck on?
Sure. So, on the traditional side of mortgage underwriting, which has always been a challenge for entrepreneurs, for business owners, there are quirks in loan guidelines that many times are overlooked, where there are self-employed borrowers who can even qualify for traditional underwriting without necessarily knowing. And that is via certain ad backs that can come into play, such as you look at somebody's tax returns, their income is, if it's reduced by depreciation or amortization, interest expense on rental real estate. Like there are certain add backs that get built into a borrower's net income, and that individual can qualify. Traditionally, a lot of people don't really know those guidelines, don't want to spend the time to calculate that. But that's always step one. Like, don't tell me what your adjusted gross income is on your personal tax returns. I want to look at your tax returns. If you have entity tax returns as well, I need to see those. Every K1, every W-2, every 1099. Like, give me the full package, inundate me with all of these documents, and let's see if it works. And if understandably so, sometimes the response may be, I don't want to go through all of that. What are our other options? And then we move on to what it's called non-QM loan program, which is non-qualified mortgage. I'm happy to get into as much detail as possible, but the bottom line is they are different underwriting methodologies that fall outside of your typical government set guidelines, whether it's Fannie Mae, Freddie Mac, FHA, via, guidelines that are established by and need to be followed to the T by the government regulators. There are those are called qualified mortgages. We move into the bucket of non-qualified mortgages, which practically speaking for the borrowers out there enables individuals to qualify for a mortgage without using tax returns, it could be using liquid assets, not to pledge any assets or commit any assets. It's just a formula that says, okay, you have $2 million liquid, we'll give you a mortgage of $1 million, as an example. Credit score matters, but traditional income calculation does not matter. Um, I would say the one product that I use the most for my self-employed clientele, that fall into this category, it's called a bank statement program. So, as an example, once again, instead of looking at tax returns and reviewing tax returns, we look at 12 months worth of business bank statements. We look at the deposits coming in, as long as there need to be deposits of business revenue, versus transfer from a personal account into your business account, business revenue deposits coming into the bank statement. And we take a percentage of that depending on the specifics of the borrower's business. And that's the income that we use to qualify. I've had clients whose net income on their tax returns could be $150,000 a year, and mortgage underwriting, income qualification using a bank statement program could be $750,000. It's a drastic difference. And what happens 100% of the time is, for those who really care, the borrowers who are asking all the questions, which I welcome, like, okay, well, what's the difference in interest rate? What's the difference in loan terms? And, a non-QM loan will always be priced worse than a traditional loan. It's, in reality, not a riskier loan many of the times, but based on traditional guidelines, it's a riskier loan. Like, there's no question about that. So the terms will be worse. But then we weigh, okay, so if your interest rate is 0.5% higher, 75 basis points higher, there's that option. Or instead of making your $150,000 a year, you need to have lower expenses in order to earn X amount of net income on your tax returns, and then figure out what your income tax consequence is going to be. And 100% of the time, the most favorable structure in an individual's overall personal financial profile is take the higher interest rate on a mortgage, without question. So, the bank statement program to me has been a great program, and it has gotten, certain clients of mine who would have zero chance of buying the property that they really want. It gives them the ability to do so, because if you look at tax returns, they could qualify for a $600,000 property. If we work off of business bank statements, they could qualify for a $3 million property. And that's what they want. They don't want a $600,000 property. They are comfortable with the payment. They're comfortable. They have the cash for the down payment. The biggest obstacle is a traditional form of loan underwriting versus a more common sense approach.
So it sounds like, if I take all that in, that there's some differences, right, between you sort of like what you see success on paper versus the underwriting. So the business maybe or maybe does not look successful externally with respect to tax strategies or income structures, but the lender's looking at it one way, and you act as that translator, David, and say, well, let's overcome some of this tension and let me translate it in a way that shines you, the potential borrower, in the best light without any, no nonsense. We're not talking about any of that, but just using these other instruments for financing to showcase what can or cannot be done and the full potential right of the buyer. Is that a fair assessment?
Yeah, great assessment. And I say all the time, the mortgage discussion many times for in a bad way is isolated within the silo of the home mortgage product versus the entire picture of someone's personal financial objectives. Like, does somebody want an interest rate of 6% and pay $100,000 a year in income tax? Or do they want an interest rate of 7% and pay $10,000 a year in income tax? Like, somebody does the math, and I could assure you option B is going to put them in a much better position in their overall personal financial profile.
Now, entrepreneurs, just knowing the mindset, about half of us self-identify as ADHD squirrels, right? So we're like here, there, whatever, all over the place. Okay, so there's that piece. But overall, we're planning towards the future. We're long-term planners and long-term thinkers. It's not just cash in, cash me at the curb. So, can any advantage be gained by a business owner to start planning early and start preparing for a home purchase? It might be months or even a year or more before they actually apply. Is there an advantage to doing that, and what should they be doing?
Great question. Oh, Dr. LL, you have all great questions, of course.
Thank you.
From experience, I will say, which the easiest first step is have a credit report run because entrepreneurs over time, very busy building successful businesses. There may have been a credit card opened 4 years ago that got used twice, just at the time it was convenient and done. And who knows what happened? There was could have been an erroneous derogatory reporting on that card. As you mentioned, there's a lot of planning that entrepreneurs are constantly doing for big picture planning, and little tiny, either a misstep that was nothing more than a mistake, not anything tied to financial distress, or truly an error that wasn't theirs, shows up on a credit report. And if that's happening today and somebody wants to close on a purchase in the next 2 months, it could be a challenge getting that cleared up versus gets run today. Ideally, there are no problems, but if there are some issues, there's at least time to get everything cleared up. So I've sat in offices of clients who are successful attorneys, and we think we're just going through a traditional loan application discussion with my laptop, and we run a credit report, and there are issues on the credit report that they had absolutely no idea existed. I think that is a very easy first step, just to, let's establish the baseline. No, okay, nothing up to date on my credit report is going to get in the way. And now we just know we're smooth sailing on that side of things, because credit reports are remarkably fickle and, really should be, should the whole credit reporting formula and industry should really, there should be a broad stroke of changes in that arena, but that's another topic. So credit, and then just the simple budgeting for cash needed to close. Here in New York City, closing costs can be extravagant, like more than down payments in much of the rest of the country. It can be just the closing costs here. So having a feel for what will be my out-of-pocket outlay, not just the down payment, but what are my closing costs going to be? So having the cash ready to deploy, is very important, or knowing what the target amount you want to have saved between now and then, taking into account that it's not just 20% of the purchase price that I'm saving for. It's X amount of the purchase price that I want as my down payment, plus closing costs. Plus, of course, nobody should ever close on a property without cash in the bank afterwards.
I think there's a flip side, right, to the way that entrepreneurs do this. So we generally try to be really aggressive, right, with respect to our write-offs, so that you try to minimize taxable income to save money, right? This is a noble strategy, it's an ethical strategy, it's a legal strategy. But I think there's, like I said, a flip side to it where it can actually work against the goal, right, of long-term borrowing. So how do we balance what we need now versus what's coming, right, when we want to buy a home?
Great question. And I will say here, and I said 20% down payment a minute ago. A lot of these loan programs, you can finance more than 80%. You can finance 90%. You can finance, you can push the needle on the finance amount. So understanding, you know, what some of the nuances are going to be of the financing options, if you put down 10% versus 20%, the 90% financing will be a costlier loan than 80%. But if you just freed up 10%, it's $1 million property, you're either putting down 200,000 or 100,000. You take slightly worse terms to put down 100,000, you just freed up 100,000 cash to allocate within your business. Understanding what the full scope of options are can also be a benefit as well, instead of just having this number that I just discussed as a budgeting process. We could budget two different ways, like budget for the max financing, so in between you have cash freed up, or budget for what's going to put you in the top tier of loan pricing, which is exclusively, again, in the silo of the home mortgage discussion.
I want to bring in some of the human side of things here, because it's always like, oh, okay, we're talking about numbers, it's business, it's this, it's that. But the human side is we want to buy this dream home and we want to get in there. Or maybe we're aspiring to that second home. Our business is doing well. And we dream of the idea of, oh, taking a week off once a year, right? To get away from our business. And so there's that human side, but there's also the piece related to that where as entrepreneurs, we're constantly being judged. We're constantly being rejected, right? Not every proposal we put out there is accepted. And so it starts to feel a little bit like the performance reviews that we left, that we had in corporate, when you think about, oh, okay, now we did a right, an assessment, right? We did a loan, we did a credit check, we did a this, we did a that. Oh, we found these blemishes. Oh, didn't you know about that? Oh, let's go. How do people react? Like you gave that example of that attorney who was saying, like, oh, here's blemish one, blemish two, blemish three. And then they're embarrassed because they're in front of you, like, oh no, I pay for all my bills. I'm never late on payments. How can this be? How does that play out?
There's definitely a level of reinforcement that I find myself, needing to explain. Is the reality is the home mortgage underwriting discussion is many times completely irrational, illogical, and not practical. It doesn't apply facts of like where we are in the real world. It applies guidelines, many of which there's no wiggle room to. So there's not like, here's one guideline, but this person is such a nice, great entrepreneur, so we're going to give this person the loan. It's if you're such a nice, great entrepreneur, then you better have documentation to support it. So there's no there the human element simply in the mortgage underwriting world, there is none. There's no such thing, in the grand scheme of things. So I find myself having to explain that, that it's it is a illogical assessment of somebody's credit risk. And I use this example all the time, and I'm a licensed real estate instructor here in New York also, so I teach continuing ed courses to the real estate community, including on self-employed borrowers. But if you're a W-2 wage earner, your qualifying income is your gross income. So you make $100,000 a year, you don't get $100,000 deposited into your bank account via direct deposit. You might net $70,000, $65,000 cash in your bank account, but you get credit for $100,000 in income. If you're an entrepreneur, you get a 1099 for $100,000. If you have expenses, then you're going to get credited for $100,000 minus whatever the expenses are. So the wage earner gets qualified based on gross income. The entrepreneur gets qualified based on net income.
Hmm.
So, it's to a certain extent, it makes some sense because if somebody truly grossed $100,000, but it cost them $90,000 to get it, that's an extreme example. But, okay, so that person, if it truly did cost them that, not a qualified borrower. But somebody who made has a salary of $100,000, we know off the bat is not walking away with $100,000. So it's just a disconnect between a more logical assessment of credit risk simply based on cash flow. I mean, people make their payments, whether it's their Con Ed bill or their mortgage. You need some level of cash coming in order to make payments. Yet the wage earner's cash flow is analyzed totally differently than a business owner's cash flow in the mortgage world.
And this is one of the reasons I was really excited to be able to do this episode because what we've really been talking about is a financial strategy for entrepreneurs, whether they're buying their own personal, like their home property, maybe they're seeking to do investments into other properties as like another way to be able to diversify their portfolios. They're still going to get dinged the same way, like you said, and it's not a fair differential. Wage earners with their W-2s, la la la, there's one set of rules. And then the rest of us that have 1099s and this and that and every other way, we get judged a little differently for these finances. So, David, as we're wrapping up the show, if there's a self-employed listener out here who's thinking about buying a property in the next 12 to 24 months, what's the smartest move they can make today?
Dr. LL, smartest move, obviously, pick up the phone and please call me. But let's
Of
just,
course.
but, that's a very self-centered answer, not for the purpose of being self-centered, but self-plugging answer. But, I think it is, and the good start is the entrepreneurs out there, you're a step ahead of the game because you're already thinking. Like there are a lot of conversations I have with prospective home buyers, existing homeowners who don't purposely don't think about anything tied to the mortgage process until the very last second that they have to, because planning is not necessarily something that they're good at. Where I think, generally speaking, entrepreneurs are just programmed to plan more. Certainly the successful ones are. So, I think it comes down to what's a monthly pay. The two biggest pieces are to think about a monthly payment budget and cash that you are comfortable allocating when the time comes. And of course, those numbers don't remain static between today and 12 months from now and 24 months from now, but to have some type of baseline established is very important. And then if business continues to grow, now that budget, monthly payment budget can increase, the cash allocation can increase, and vice versa. Or it stays the same in terms of the mortgage and home budget, and there's more cash allocated to attribute towards the business. So I think establishing a baseline of monthly outlay and then the baseline for cash that's planned to be allocated are the two key steps. And then also, again, depending on the type of property in terms of monthly payment budget, is what are the monthlies aside from principal and interest? Property taxes, if it's a condo, what are the common charges? If it's co-op, what are the monthly co-op dues going to be? Those can range very widely, and many times it's reconciled in the purchase price. So somebody may see, oh, wow, great, this condo's only $750,000. Yeah, well, that's because the property taxes are disproportionately high and the common charges are disproportionately high. So the sticker price looks great, but then you do the math on what your monthly payment budget is going to be, and it's a lot higher and disproportionate to what is viewed as, a relatively low purchase price. So, having those two budgetary thoughts and then factoring in, what are the monthlies of a prospective property, all ties into that as well.
Oh, I agree. It's like the airlines, right? About a year or two ago, they started that. So you think, oh, that looks like a great flight price, $349. Oh, no, no, no. Wait a minute. That's basic economy. You only get a personal item. You don't even get a carry-on. Now you got to add the carry-on fee. Oh, no, no, wait. You need a little more luggage. Well, that's another fee. Oh, wait a minute. You've got to pick your seats. And those are 25, 45, $75 per seat each way. So suddenly the deal doesn't look so good,
No, it's
right?
great. Great analogy. Great analogy.
It's crazy. And I would agree with you that entrepreneurs are generally better long-term planners. And I would say that entrepreneurs are definitely better problem solvers because that is entrepreneurship, right? One battle after another. It's like, oh, okay, now what do I do? Pivot. No, now what do I do? Pivot. Right. That's what entrepreneurs do. Now, bring it back to you. You said where we do want to find you, you said self-serving. How do people call you, David? How do they get a hold of you? What do they do?
I am available on my cell phone 7 days a week, 646 708 5048. My website, my URL is DO, as in my initials, David Ostrowsky, docloses.com. Because I really love to close deals. That's what I love to do. docloses.com. And I'm here in New York City, sitting in Manhattan right now, and love to. I really enjoyed this session, Dr. LL, and I would love to service your loyal listeners and growing fan base that you have.
Yes, well, thank you for that. And I am so grateful to the folks that we have, like I said, as guests and our listeners. It is really growing. Now, last question. If we got a chance to look in that New York closet of yours and there was some footwear that best personified who you, David Ostrowski, is, and when you put those footwear on, you're like, yeah, this is me. This is how I roll. What are we looking at, and why is that just oh so you?
I love that question. So right now, Greats, which happen to be a Brooklyn-based company. The CEO happens to be a client of mine. Greats are is the name of the company. Great footwear, ranges. They do have some shoes. I wear their sneakers, which is more, I would say, a more stylish sneaker look versus a quote shoe look. So that's where I am now. That's after many years. A good, very good buddy of mine used to have a store, Classic Kicks, on Elizabeth Street in Manhattan, where they special, there are a lot of Nike Dunks and Air Force Ones, and then I used to get my own, used to design my own Nikes at the Nike ID store. So for many years, I was a Nike Dunk wearing person. I've since shifted more, I've gotten, I'm a little older now than I used to be. So now, not that greats are for older people, but, I might not be as cool to wear the dunks as often as I used to love to do. So long-winded answer. Right now in the closet, I still have my Nikes that I design personally, because I don't want to, not until I really have to get rid of those, will I? Um, but Greats, shout out to Greats, Brooklyn-based company. That's what I'm wearing and what I will continue to wear.
Excellent. And that is oh so New York, right? We plug our own, we support our own. That's how this works. I'm on the other side of the Hudson, but I'm only 8 miles away from Times Square,
Oh,
so I'm not that far.
okay.
Anyway,
Well, listen, I grew up in New Jersey. I call it the greatest state in the Union. My parents live in New Jersey. I love New Jersey.
that's awesome to hear because most New Yorkers don't say that. So, with that, that's a wrap. David Ostrowski, thank you so much for being on our show. And if people want to get a hold of you, we know deocloses.com, loan officer with Cross Country Mortgage. Thank you so much for being on the show today.
Thank you, Dr. LL. It's been a great pleasure.